When most people think about who buys American government debt, they picture foreign countries like China or Japan, maybe wealthy investors or pension funds. But here's the twist that should keep you awake at night. America's biggest creditor isn't some foreign power or Wall Street titan. It's America itself. The Federal Reserve, our own central bank, has become the largest purchaser of U.S. Treasury bonds, creating money out of thin air to buy debt issued by the very government it serves. This isn't some obscure financial footnote. This is the foundation of the modern American economy, and it's a machine that runs on a logic so circular it would make your head spin. We're living through the most audacious monetary experiment in human history. A system where the government borrows money, the central bank prints money to buy that debt, and somehow this is supposed to create prosperity. It's like a financial perpetual motion machine, except perpetual motion machines don't exist in physics, and they don't exist in economics either. But that hasn't stopped us from building our entire monetary system around one. Let me paint you a picture of how this works, because once you see it clearly, you'll never look at money the same way again. When the US Treasury needs cash, it issues bonds. These are IOUs, promises to pay back borrowed money with interest over time. In the old days, these bonds were sold to actual investors with actual money. Banks, insurance companies, foreign governments, wealthy individuals, people who had saved real wealth and were willing to lend it to Uncle Sam in exchange for a steady return. But something changed after the 2008 financial crisis. The Federal Reserve, which had traditionally played a smaller role in buying government debt, became the buyer of first resort. Through a program called quantitative easing, the Fed began purchasing Treasury bonds on a scale that dwarfed anything in American history. Between 2008 and 2021, the Federal Reserve's balance sheet exploded from under $1 trillion to nearly $9 trillion. Most of that expansion came from buying government debt and mortgage-backed securities. Here's where it gets truly mind-bending. The Federal Reserve doesn't have $9 trillion sitting in some vault somewhere. It creates that money electronically with keystrokes on a computer. Digital dollars conjured into existence for the sole purpose of buying government IOUs. The Treasury sells bonds to the Fed pays with newly created money, and the Treasury uses that money to fund government operations. It's a closed loop that would make a counterfeiter jealous, except it's completely legal because the people doing it wrote the laws. Think about the implications. The government spends money it doesn't have by borrowing from a central bank that creates the money it lends. The debt gets bigger, so more money gets created to buy more debt, which makes the debt even bigger, requiring even more money creation. It's a cycle that feeds on itself, growing larger with each revolution, and we're told this is not only normal but necessary for economic stability. But wait, it gets stranger. When the Federal Reserve buys Treasury bonds, it doesn't just hold them like a normal investor. It pays the interest it receives right back to the Treasury. So the government is essentially paying interest to itself on money that was created from nothing. It's like borrowing money from your left pocket to pay your right pocket, then paying interest from your right pocket back to your left pocket, except somehow this creates wealth for everyone involved. The scale of this operation is staggering. As of 2023, the Federal Reserve holds over $5 trillion in US Treasury securities. That's roughly a quarter of all outstanding government debt. Add in the mortgage-backed securities, and the Fed owns assets worth more than the entire economic output of most countries. This isn't monetary policy anymore. This is monetary fantasy, a system that operates on principles that would be considered fraud if anyone else tried them. And here's the kicker. This isn't some emergency measure anymore. What started as a crisis response to the 2008 meltdown has become the new normal. During the COVID pandemic, when the government needed to spend trillions on relief programs, who stepped up to buy the debt? The Federal Reserve, creating more money to purchase more bonds, expanding its balance sheet by trillions more. The machine had become so essential to government operations that turning it off wasn't even considered an option. Now you might be thinking, if this system is so problematic, why does it seem to work? Why hasn't the economy collapsed under the weight of all this printed money and circular debt? The answer lies in something economists call the exorbitant privilege. Because the dollar is the world's reserve currency, foreign countries and institutions have no choice but to hold dollars and dollar-denominated assets. When the Fed creates new money, it doesn't just stay in America. It gets exported to the rest of the world through trade and investment, spreading the inflationary effects globally while allowing Americans to consume more than they produce. But this privilege isn't permanent, and the cracks are starting to show. Foreign central banks are diversifying away from dollars. Alternative payment systems are being developed to bypass dollar transactions. Countries that once eagerly accumulated treasury bonds are becoming more selective buyers. The system that has allowed America to print its way to prosperity is facing challenges that threaten its very foundation. The mathematics of this debt cycle are becoming impossible to ignore. Interest payments on the national debt now consume more than 15% of all federal spending, and that's with artificially low interest rates. As rates rise, those payments will consume an even larger share of the budget, requiring more borrowing, which requires more money printing, which puts more pressure on the dollar's value and credibility. It's a vicious cycle disguised as monetary policy. What makes this particularly dangerous is that most Americans have no idea how any of this works. They see rising prices, stagnant wages, and growing inequality, but they don't connect these problems to a monetary system that systematically transfers wealth from savers to borrowers, from workers to asset holders, from the present to the future. The endless debt cycle isn't just an abstract financial arrangement. It's a machine that reshapes society, concentrating wealth among those who understand how to game the system while leaving everyone else wondering why their dollar buys less each year. The question isn't whether this system can continue forever. The question is what happens when it finally breaks down, and who will pay the price when the music stops. The most insidious part of this endless debt cycle isn't just that it exists, it's that it has rewired the entire American economy to depend on its continuation. We've built a system where stopping the money printing would cause more immediate pain than continuing it, even though continuing it guarantees far worse pain down the road. It's like a drug addiction at the scale of a nation, where the withdrawal symptoms seem worse than the slow poison of staying hooked. Consider what happens when the Federal Reserve even hints at slowing down its bond purchases. Markets panic, stock prices plummet, borrowing costs spike, politicians demand action. And within days or weeks, the Fed reverses course, promising to keep the money flowing. We saw this play out in 2018 when the Fed tried to shrink its balance sheet. The market threw such a tantrum that policymakers quickly abandoned their plans. The message was clear. The system had become too addicted to printed money to function without it. This creates what economists politely call moral hazard, but what normal people would recognize as the destruction of basic financial discipline. When you know that any serious problem will be solved by creating more money, why worry about debt, efficiency, or sustainability? Corporations borrow recklessly because they know bailouts are coming. Politicians spend without restraint because they know the Fed will monetize the debt. Investors pile into risky assets because they know the money printer will backstop any major losses. The result is an economy that looks prosperous on the surface, but is hollow underneath. Asset prices soar, not because the underlying assets are more valuable, but because there are more dollars chasing them. Stock markets reach record highs while Main Street businesses struggle. Real estate becomes unaffordable for ordinary families, while investors with access to cheap credit buy up entire neighborhoods. The wealth gap widens not because of differences in productivity or merit, but because of proximity to the money spigot. And here's where it gets truly perverse. The people who benefit most from this system are the ones who understand it least publicly, but profit from it most privately. Wall Street banks that serve as primary dealers for treasury auctions get first access to newly printed money. They can borrow at rates near zero and invest in assets that appreciate as more money enters the system. Meanwhile, pensioners and savers watch their purchasing power erode as the dollars they've accumulated over decades buy less and less. The Federal Reserve tries to justify this wealth transfer by claiming it creates jobs and economic growth. But what kind of jobs? What kind of growth? Much of the employment created by easy money policies is in sectors that exist primarily to shuffle around financial assets rather than produce real goods and services. We get more hedge fund managers and fewer manufacturers, more financial engineers and fewer actual engineers. The economy becomes increasingly financialized, dependent on asset price appreciation rather than productive innovation. Even more troubling is how this system corrupts the basic relationship between government and citizen. In a healthy republic, politicians must make tough choices about spending because resources are limited. They must weigh priorities, cut waste, and justify expenses to taxpayers who ultimately foot the bill. But when the central bank can create unlimited money to fund unlimited spending, those constraints disappear. Politicians can promise everything to everyone, secure in the knowledge that the bill will be paid with printed money rather than higher taxes or reduced spending elsewhere. This is how you get trillion-dollar infrastructure bills that infrastructure experts say won't significantly improve infrastructure. This is how you get endless wars funded not through war bonds that citizens must buy, but through money creation that citizens don't even notice until prices start rising. This is how you get a government that grows larger and more expensive every year, regardless of which party controls it, because the normal feedback mechanisms that would impose fiscal discipline have been severed. The international implications are equally staggering. When America prints money to buy its own debt, it exports inflation to every country that holds dollars or trades in dollar-denominated commodities. Poor countries that have accumulated dollar reserves as insurance against economic shocks find those reserves losing value. Oil-producing nations that sell their resources for dollars watch their wealth evaporate as those dollars buy less. Emerging markets that borrowed in dollars face impossible choices as their debt burdens grow heavier with each round of American money printing. This is economic imperialism disguised as monetary policy. America gets to consume more than it produces while forcing the rest of the world to absorb the consequences. But empires built on such foundations don't last forever. History is littered with reserve currencies that seemed permanent until they weren't. The British pound once enjoyed the same privileged position the dollar holds today. Before that, it was Spanish silver, backed by mines in the Americas that seemed inexhaustible. The endless debt cycle isn't some distant economic theory. It's the machine grinding away beneath every paycheck, every savings account, every retirement plan in America today. And like every perpetual motion machine in history, it will eventually stop. The only question is whether you'll understand what's happening before the music stops, or whether you'll be left holding worthless paper when the illusion finally breaks. History has the answers if you know where to look.